The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast. If you could all do us a favor, we would love it if you would forward this podcast to all your friends and family and coworkers. Give them a chance to view this too. It helps us get the message out we're looking for. We'd really appreciate that. Thank you in advance.
Also, if you go to our website, the shortcut to our website is based on our old radio program, iriradio.com, and you can register for the December stock market updates. First Saturday of September, run about an hour. We give you some basic information about financial management and portfolio, and then we talk about stock market stuff itself and what we see going on in the current environment. So you get rounded education on finance, plus you get specifics about the market. And you can register with just a couple of clicks at iriradio.com. Well, the big news, of course, that dominates almost everything in the financial markets is what on earth is going on with Donald J. Trump, president-elect, and his impact on the markets. Then there are a lot of different theories depending on which side of the fence you're standing on.
It's true.
He's either going to blow up the country or it's going to get a lot better because we're going to get government out of our lives. Well, not entirely, but reduce the impact, hopefully to a large degree.
Right.
And it's being done with some humor along the way because he's a digital coin advocate. He apparently had new revelation during the course of his run for re-election, new understanding about digital coins and what they mean and what their prospects are. So we're looking forward to an administration that has a positive outlook on Bitcoin and all the other related efforts at emulation. That's a real change from where we are with the current administration that has been doing its best to beat it up with proposed regulations, registration, as well as increased regulations on virtually every other phase of business in our country. So change is a coming. We just don't know exactly what all the ramifications are.
No, that's always the exciting part with if you're going to look at politics and mix that with we always advise never mix politics with investing, but there's no way to say they're not related. They affect each other, and a bad economy can make a presidential change necessary, and policies that you think are going to be spectacular for the economy can turn around and not be quite as good as you thought. You just never know, like anything else. So we recommend doing very little investing based on any political outcome. But there's definitely good reason to pay attention to what's going on and kind of look at which direction's the wind blowing now and where things might begin to trend. And that's what we do. We watch for that to show up.
So one of the things that you need to be really careful about with regard to any presidential election is forecasting and making bets on them.
Oh, yeah.
There are a lot of major firms that employ many economists to try and figure this out, and they do take bets in advance, but they also generally run a portfolio that's referred to as modern portfolio theory, where it's broadly diversified over all 11 market sectors to some degree or another. Some are overweight, some are underweight, and they'll move them around just a little bit depending on what those forecasts are. That's a bet on the future, and nobody knows the future. We don't know the future. You don't know the future, and I can guarantee you, Jamie Dimon doesn't know the future either.
No.
That doesn't prevent him and his firm from making bets on the future. We prefer to look at what's going on right now in a relatively short period of time and say, this is the way things are. What do we do knowing the way things are today?
Right.
With a short term look back over the last month, where are trends heading? Well, you can adjust that fairly easily and not make big mistakes. But if you're betting on a certain outcome that's going to happen with proposed legislation that may never get out of either part of Congress, either house of Congress, that's a big bet and has a lot more risk associated than analyzing where you are today. One of the things that we see changing in the current administration is the new administration is bringing in new heads of department. These people that are coming in to office next January after the inauguration are coming to government with a massive amount of successful business experience. That is rare. Most of the time, what we see running bureaucracies are people who have never signed a payroll check on the front side. They're always depositing, but they're never having to pony up the money to pay somebody else the payroll to keep their business running. And we are going to get a new perspective in the way government runs because of this administration and the number of high powered, successful CEOs that are stepping up to the plate and saying, it's my time to serve the country. And yes, I will walk away from my CEO position and that salary. Not that they're going to be hurt by that,
Right.
because these are wealthy people. They're wealthy because they have made successful businesses very large, and they're coming in to assist President-elect Trump with how do we clean up the mess that we have right here. That should be good for all of America, and that's why there was a mandate and a landslide that was not foreseen by most of the pollsters. That should be good news for everybody and should be for the market. But
Should
be
be. And
careful.
then again, like you said, Don, that's the most important thing is that you still need to not place your economic bets based on the outcome. It looks if you're for less government is better government, it looks very promising for where we're going. It should be more efficient. There should be less waste, and that's a lot of shoulds. That it should work out that way, but we don't know that yet. And so making a significant change in your portfolio based on an election is just like you said, Don. It was the most important thing we've covered so far. I think that's even riskier than looking at the market and trying to make a market decision. Making a decision based on a political outcome is just absolutely, it might as well go to Vegas because there's no way to tell what the outcome's actually going to be. And that's when being trend followers can really work to your advantage. You can wait for that momentum to build up. You can follow the money into the market. You can follow the changes that are probably going to take place because it looks like there should be some significant changes in the way the dollars of the U.S. government are allocated, and that can make a huge shift in what's going on in the economy in general. And when that happens, it's nice to be able to say, and we're going to adjust to where that is instead of we're just going to buy everything and hope it works out, which is what that pie chart's doing for you if you're a standard investor who gets the pie chart and says, well, let's just buy a bunch of stuff and hope some of it works, which is all modern portfolio theory is. Let's hope something works instead of looking at what is working and let's try to concentrate there. That's really what we try to do.
So I just took off a screen share, which we were looking at before we started here. I'm going to put it back up primarily because this has to do with betting on the come. And so
Yeah.
one of the announcements that's happened recently was that Robert Kennedy Jr. is going to be in charge of 11 different uh, bureaucracies. I mean, he's known as an anti-vaxxer, anti-polluter, and he has government shaken up. I mean, the bureaucrats are really shaking in their boots. Some of whom on social media have said, I'm out of here. I am not going to stay around to see what happens.
Can't deal with this. Yeah.
One of those areas is in the Department of Health, and what people are anticipating is that his what they don't even know what his changes are, but they're betting they do, and they are driving prices of vaccine makers down. These prices are dropping, and the entire whole healthcare sector, which is in this bottom chart, relative to the S&P 500, has been a significant underperformer. And actually, it's been an underperformer all year, but since the announcement of Robert Kennedy Jr. to head up these departments, it has just basically collapsed down here. That's a bet on the come because we don't know exactly what his proposals will be, and two,
Right.
we don't know how efficient it will be to get them implemented in any of the departments that he's going to oversee. So
Sure.
the issue is really you should be waiting to see what's going to happen. What is the real news? And I mean, our view is if you, instead of looking back over the last 80 years to determine average returns, let's look back over the last month and see which sectors are actually gathering investor confidence, evidenced by the fact they're putting money into it. So the
There you go.
returns on those positive sectors dominate the data. Investors make decisions. Remember the old TV show Who Wants to Be a Millionaire?
Sure.
So if you were up and you had to answer the questions and you got stumped, you had a couple of choices. You could call an expert. You could I don't remember one. The other one, there was a third one, which was to call on the audience. And
Right.
there was a third choice. So it turned out that when the program's all over and the series is ended, that the most correct answer, if you didn't know it, was to poll the audience. Collective information represented the best answer most of the time. And that's what the stock market is. Who wants to be a millionaire? Look where the money's going. And if the money's going into like one sector and is leaving another, but you still own the other, we ask the question, why are you doing that? Because the more people leave, the lower prices are going to be. You have to have buyers in the market in order for prices to rise. Easily measured in volume,
That's it.
in direction. It's not rocket science, but it does show, I would say, the futility of betting on the come when there's really no data to support it. It's just like assuming any one of these new department heads, cabinet heads, is going to have a predetermined outcome in their impact on legislation. We don't know that. I mean,
Correct.
you certainly have variables that make it go one way or the other. So let's deal with our portfolios in a structured, disciplined, decision-making manner. And I guess I could say that's our gig. That's what
That's
we
what we
do.
do. And it's important to wrap your head around the fact that when you're investing based on that pie chart, when you're getting that diversified asset allocation pie chart, 60% stocks and 40% bonds, that is based on no data with anything to do with what's coming up. It's all historical data. It's all what happened over the last 80 years. It's got nothing to do with today's economy, what's going on now, or what's going to go on in the future. There is zero predictive value to it at all. So it's not that you're going to be in the right place at the right time. You're just going to be everywhere and hope the good stuff outgains the bad stuff because you're always going to have a bunch of stuff losing money. That's the way it's supposed to work. And we decided that's not the best way to adjust a client's portfolio. Follow the money, look for the trend, and be where the magnets of money are. Find out who's attracting cash. Follow that. And like you said, Don, it's not. There's lots of data on that. Follow the data and forget about your opinion about, well, everybody says I should be diversified, so let's just do that. That's a sales pitch from a broker trying to keep your money invested in their brokerage firm and nothing else. And it's important to remember that.
Well, and Warren Buffett's opinion on diversification, we can quote him as saying diversification is for people who do not know what they are doing.
There you go.
And that's a problem. So we want to diversify, but we want to diversify intelligently into things that are rising in price, where the trend is positive and supports us, rather than things that are falling apart, as in the case with bonds over the last 4 years, which have 4 consecutive years of negative returns. And yet that's the safety valve that most advisory firms put you in. We don't
Right.
do that. We own bonds when bonds are profitable. But we're basically out of time in today's session. If you like what you heard, found it interesting, we appreciate you taking time to share this with your friends and your coworkers. You want to find out what we think about the market, and each month we do a free webinar on the first Saturday of the month. Go to our website, iriradio.com. There's a couple of clicks. You can register for that. If you can't attend on Saturday morning and you register, we'll send you a link that you can watch it on your own time. For now, down below, subscribe to our podcast if you haven't already. Thanks and have a great day.